Hello and welcome to Quiltervious Markets Uncut podcast, your weekly insight into the topics and issues that we have been discussing here at Quiltervious. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you are listening on, or by following hashtag QCBComment on LinkedIn. I'm Andrew Cartwright, investment manager based out of our Birmingham office, and this week I'm joined by regular commentator and head of fixed interest Richard Carter and equity research analyst Tom Gilbey. Welcome, Richard and Tom. So with financial markets still fixated on when and how quickly interest rates will start to fall, we had some important announcements around inflation last week. And that included somewhat disappointing news from the US, where inflation ticked up to slightly to 3.2% in February from 3.1% the month before. And that left equity markets somewhat unsettled, with notably the US technology stocks selling off on Friday. Whilst inflation has been falling sharply and is on the right trajectory throughout Europe, the US, and the UK, those central banks may well be feeling justified in adopting a more cautious approach. And indeed, the European Central Bank left interest rates unchanged again last week. But it is still a very fine balancing act between managing inflation whilst avoiding the prospect of a hard economic landing and recession. And in the US, it was also reported last week that whilst retail sales increased by 0.6% in February, this was below expectations for 0.8%, which was a figure that had already been revised downwards. And in the UK, we know that high interest rates are having an impact, with UK mortgage arrears are at a 7-year high. So, Richard, what did you make of those inflation figures and data last week? Were there any obvious explanations for that slight lift? And more importantly, with the US Federal Reserve and the Bank of England due to meet this week, what might that mean for the outlook, for the timing and extent of interest rates cuts throughout the year, and the implications for financial markets?
Yeah, you're right. I mean, you're right to say that inflation is on a sort of better trajectory, I think, and so we shouldn't get too carried away with the odd blip up. But I mean, it certainly is proving to be pretty stubborn in the US, and from a variety of different areas. I mean, the key one really is the kind of service sector. You've got a very strong labour market, strong wage growth, and there are areas like shelter costs, or housing costs, and things like motor insurance, which we're quite familiar here in the UK. Costs have gone up a lot in that area as well. But also for the last year or so, we've had this sort of disinflationary effect from goods prices and things like food, and that's slowing down now actually. So the sort of benefit from lower goods prices is starting to wane, and that's pushing up the inflation numbers slightly. But as I say, I wouldn't get too carried away. I mean, the implications for the Fed really is actually the market is back to, in terms of rate expectations, the market is kind of back to what the Fed's been saying all along, which is, yes, we'll get to rate cuts at some point, but not yet. And when we do, there may be 75 basis points of cuts this year. So in some ways, the Fed and the market are now pretty well aligned. So I guess that in terms of financial markets, that's quite good, potentially quite good news going forward. The Fed meetings this week, I don't expect them to make too many changes in terms of the outlook. And as I say, inflation is stubborn, but it's not as high as it was a year or two ago. And the same goes to the Bank of England, really. I think we've got UK inflation numbers this week. Arguably, things potentially could turn a little bit more dovish here in the UK, with growth quite slow, inflation falling. So maybe we'll have a slightly more dovish message from the Bank of England. But again, rate cuts not on the agenda, at least for the next 3 to 6 months.
So just sort of moving on slightly from the sort of financial and the Bank of England and Federal Reserve meeting next week. Over the course of the weekend, Russia held their presidential election, and that included 5 of the occupied Ukraine regions, and the preliminary results are indicating that Putin is well on track to be re-elected with a record 87% of the total vote, and on the back of a record turnout, and which I don't think the outcome of the Russian election will come as any surprise or shock to anyone. But it does remind us that 2024 is a busy year for elections and around the world, and we have sort of talked a little bit about the US and UK elections before. But are there any updates on those sort of forthcoming elections elsewhere, and notably, of course, as far as we're concerned, in the US and UK?
Yeah, I mean, I think the US and UK elections will be a lot closer than the Russian ones, with potentially less dangerous consequences for those standing against the government. Yeah, I mean, I think by the looks of it, we know US now, unless there's some sort of major shock, it's going to be Biden versus Trump in November, which is again, slightly depressing prospect, but there we go. UK is interesting. They've got a lot of speculation at the moment. I think perhaps in some ways, because there's so little politically going on in terms of actual policies or anything, and things going on in Parliament, I think it's kind of silly season a little bit on the political front here, and everyone's sort of focusing on, maybe 2 or 3 Tory MPs who are unhappy about Rishi Sunak, but he's clearly struggling, and I guess there is a danger that if a leadership bid is mounted, although I don't expect it will be, but if it is, he might just decide to go for an early election in May, with all the consequences that would probably have in terms of a change in government. But I suspect at the moment, unless there's some major, or Sunak just decides to throw in the towel, I suspect we'll have both UK and US elections in November. So that's going to be a very busy time.
Great, thank you, Richard. So the main focus in equity markets has for a very long time been on high growth US technology stocks, and quite rightly so. They've simply been the sort of key drivers of equity returns. And again, we saw sort of new all-time highs in January. The UK equity market is composed far more of mature sectors, including oils, miners, financials, pharmaceuticals, and in terms of investment style, is much more value orientated than growth. And whilst all majors certainly had their moment in the sun in 2022 with their rising energy prices, the UK equity market has lagged well behind the US, and the difference in current valuation of those two markets reflects that. UK equity valuations certainly do not appear expensive, and this might explain why we're seeing a pickup in M&A activity, with a number of bids being made for UK companies, including DS Smith and Direct Line. Now, Richard mentioned that the recent uplift in UK inflation was due in part to an increase in car insurance prices, and no doubt anybody who has renewed recently will have noticed that. So very pleased to be joined this week by Tom Gilbey, our research analyst who covers the insurance sectors. Tom, we've seen some activity in the sector over the past few weeks with that takeover approach for Direct Line, and Admiral also announced their results the other week. Could you tell us a bit more about what's been happening in the sector? Has that price inflation had an impact on company results at all?
Yeah, so I think it's worth just circling back to March 2020 just to set the scene as to what's kind of happened over the last few years. So, going back to March 2020, when the country went into lockdown, it resulted in much less driving and therefore sort of much less claims. And that subsequently caused supernormal profits for the motor insurers. However, as we kind of emerged from the lockdowns and inflation started to pick up, the motor insurers are met with this sort of perfect storm whereby claims frequency returned and they were met with this massive cost inflation. So that resulted in a big profitability hit. And you could see it in the industry sort of combined ratios, which reflect their profitability. They went way higher than they normally do. So in response to this, the motor insurers have put through price increases for several consecutive quarters in an attempt to catch up with cost inflation. For the last year or so, you've been seeing these price increases coming through sort of double-digit amounts, but it's really taken time to work through into the results because of the large shoot up in inflation. However, I think in the most recent results, we're finally beginning to see the green shoots of recovery. You're seeing profitability beginning to return, and you're seeing the real kind of pricing power that some of these better businesses in the sector do have. And I think you touched on the takeover approach for Direct Line. I think that just kind of highlights the attraction that is present in the sector right now, as they have finally caught up the pricing with cost inflation and profitability turns back to normal.
So you've also had the life insurance companies reporting very recently as well, and specifically Legal & General and Aviva, which are two of the major players in that sector. And we know that the UK equity market is more value biased, and this typically means that dividends form an important part of overall total return. But even taking those factors into account, what really stands out about these companies is the dividend yield. And I think Legal & General is nearly at 10%, and Aviva not too far behind that. And as a seasoned investment manager, there are a few things that make me somewhat nervous. And one of those is the prospect of a bubble. When stock and sector valuations become increasingly stretched, to what seem unsustainable levels. And the other is when stock yields are very high and concerns start to arise over a value trap. And this happens when yields look attractive, but the dividend can't be sustained, is cut, and the share or the support for a share price disappears. And the collapse of Carillion has been an extreme example of that. And in either situation, corporate earnings are key, and whether, as in the case of a bubble, future earnings can grow quickly enough to justify the current rating, or if earnings can be sustained to support dividend payments. And Tom, how did the recent results at Legal & General Aviva fare? And what are your thoughts on the outlook for those companies? And in particular, did they make any reference to their dividend policies?
Yeah, so both companies had pretty solid set of full year results. I'd say Aviva's probably looked on the whole more impressive. That was primarily due to their general insurance business, which performed very well. And that was really due to the previously mentioned factors when talking about the motor insurance. And they've seen a strong bounce back in profitability there. L&G, I'd say, it was kind of mixed, but on the whole solid. They saw good performance in their pension business. And pleasingly, they saw some improvement in the investment management division, which has been a problem area for quite some time now. I think the outlook for both companies look promising, and there are kind of nuances to both businesses. Aviva upgraded their 2026 target, which I think, kind of shows the confidence they have in their outlook. L&G, we're in a almost wait and see mode. They've got a new CEO who's going to update the market on his strategy in June. So whilst there's, we saw the opportunities in the company from both the pension business, which continues to have record sales there as the demand for pensions continues to grow. You're also seeing the investment management division beginning to turn around. But I think we'll probably get a clearer view on the outlook for L&G at their capital markets day in June. Regarding the dividends, because I think it is a really interesting point at the moment that you're getting these companies at close to 10% dividend yields, and both companies did touch on the outlook for their dividend growth. So L&G have guided for their dividend to be increased 5% next year. Aviva have guided for mid-single digit growth. So I think it shows the confidence that both of these companies have, that they're targeting not just some slight growth, they're targeting mid-single digit plus growth in their dividend per share.
So you've highlighted that many of the insurance and life insurance and financial companies across the board have high dividend payouts. The one that stands out to me, and sort of notable exception, is Prudential. And sort of from memory, it certainly used to be a good dividend payer, and it was also a well-recognised brand here in the UK, but this no longer seems to be the case. Tom, there's been sort of quite a shift in corporate strategy at Prudential perhaps over a number of years. And could you tell us a little bit more about that and what that means for the outlook for the company and the implications for shareholders?
Yeah, it's definitely true that Prudential stands out versus the other UK insurers in both its dividend yield and its sort of overall strategy. So, as you said, it's undergone quite a shift in recent years. It's spun out M&G and Jackson Financial really to become a leading Asian insurer that's focused on the growth opportunity out there. It's a very different makeup to the other insurers in the sector, whereby it's growing at a faster rate, but paying this much smaller dividend. And that's because they see opportunities to invest organically in the business and want to pursue these growth opportunities rather than pay out cash to shareholders. The longer term drivers remain very strong for this business. Essentially, in Asia, you've got an underpenetrated market from an insurance perspective. And they think as these economies continue to get wealthier, you'll see penetration increase and you'll see growth accelerate in Prudential. The CEO joined around a year ago, and the strategy has really been evolution rather than revolution. He's a very well-respected operator in the Asian market. His background's from in that area, and hopefully he's going to be able to capitalize on this opportunity in Asia. Their full year results are due later this week, so hopefully we'll get a bit more of an update then. But I think the big picture is that versus the other insurers, they are seeing this big growth opportunity and they want to capitalize on this, so invest organically into the business to make the most of the opportunity they see there.
That's great, Tom. Thank you very much for the update on those sectors and companies, and to Richard for those great insights, and to you all for listening. And did you enjoy our discussion on the podcast today? We'd love to hear from our listeners, so please review the show wherever you are listening and share it on your socials and tag us at @QuiltAchieveit. To make sure you don't miss a future episode, tap the subscribe button. We'll be back next week, and in the meantime, head over to our website, www.quiltachieveit.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. Finally, if you have any questions you'd like to ask one of our experts for our next podcast, then simply ask them via the weekly comments page on our website. We love to hear your questions. And that's it for today. So thank you again to Richard and Tom, and to you all for listening. See you next time.